Welcome back. You're watching Investor's Guide. We're talking about your portfolios. Now, earlier in this show, we talked about portfolios designed for younger people in the age group of 25 and 35. Now, we're moving on to the next age group. Our stable growth portfolio is designed for someone who's 45 years old, which means that it's a portfolio that involves less work, less management, and less risk. Now, this portfolio, it was designed by Dhirendra Kumar, who's still on the show with us, and we're going to talk about whether or not he wants to make some changes and how this portfolio is doing so far. These are the funds that we've invested in. There are 4 balanced funds: TSP BlackRock Balanced, FT India Balanced, HDFC Prudence, and Reliance Regular Savings Balanced Fund. So far, Dhirendra, it's given us an annualized return of 5.4%, which is not very high because earlier in the year we started off with a fairly higher annualized return of between 20, then it came down to 12. Are you disappointed with the way this fund has been, this portfolio has been performing? Do you want to make any changes, or do you think you like the way it, the simplicity is holding good so far?
No, this portfolio I have not made any changes, and there is not a need to make any change. The whole premise that it should be simple, and we are targeting a allocation of 65 to 70% into equity, rest in fixed income, in a narrow band, in a tax efficient way, and without the need to rebalance, because these balanced funds ideally should take care of the rebalancing at their own level. So in terms of running this portfolio, it is the easiest thing to do. It has been a little disappointing because some of these funds, or in fact most of them, have my expectation from a balanced fund, the way they are designed, the kind of investor buy them, I was expecting that most of them will have a large cap tilt, and quite a few of them have actually tilted quite heavily to small and mid cap, which was not the deal, which was not the understanding. So and that has actually taken a drag, that has actually taken its toll on the performance. But it is still not alarming. It is not very disappointing. It is a little disappointing.
All right, moving on now to our portfolio designed for a 55-year-old. This is our conservative portfolio, and it is exactly that. It's conservative. These are the funds that we've invested in: the FT India Dynamic PE Ratio Fund of Funds, the HDFC MIP, and the Reliance MIP. Now, remember, this portfolio is designed for someone who's 55, which means you have 5 years to retirement, and you're approaching that period of your time where your income will now then shift to your investments. Your investments will be expected to generate that income for you. So the idea with this portfolio was to protect your life savings. So Dhirendra, do you want to make any changes in this portfolio? 2 MIPs, 1 fund of fund, PE ratio fund of fund. Do you think that you need to make any changes at this point?
No, not at all. In fact, this portfolio has done exceedingly well, nearly 7.5% return, and I don't think, and the FT India Dynamic PE Ratio Fund has done the job exceedingly well. It has been able to protect the decline and guard our gains. So I think this is a portfolio I'm most satisfied with.
All right, so this portfolio, if you take a look at it so far, it's given us a return of 7.2%, the annualized return of 7.2%, which means it's doing better than a lot of our other portfolios. Can you explain to us again the concept of using an MIP for someone who's still earning a salary? Why did you pick these 2 funds?
No, we have not particularly chosen MIP for its MIP. We are basically targeting a 70% fixed income and 30% equity portfolio, and that to my understanding is something which will help you guard yourself against inflation, and you will be able to benefit from the equity values. The 30% allocation ensures that, and the potential significant decline in value, which could be quite unnerving for somebody who is approaching retirement. That is why you have 70% into fixed income. I think good days are ahead for this portfolio, because the fixed income yields has gone up. So this fund is bound to do well with a larger part of its allocation.
We're trying to keep our exposure to equity down for those of us in the age group of 55 who are nearing retirement. The idea really is, like we said, to protect your life savings, to reduce your equity exposure. Our portfolio flashing on your screen, this is our conservative portfolio. Remember, designed for someone who is approaching retirement. So even if you're not 55 years old, but you're looking forward to retiring in the next couple of years, this is possibly a portfolio that you should consider. So, time to squeeze in just one question that's come in from someone in this age group, 50 years old. Colonel Dhirendra Singh has written in. He tells us he has 3 LIC policies. Jeevan Anand, for which he's been paying premiums. He's paid all the premiums so far, about 6,500 rupees per year. Profit Plus Plan, 3 premiums paid of 50,000 rupees a year. And Jeevan Suraksha, for which he's also been paying premiums. He tells us that the annuity will vest in a little while, and the pension installment will give him about 3,200 rupees as monthly pension. He wants to know what he should be doing with these policies. 3,200 rupees as a monthly pension for something that you've been investing in for several years. Does that even make sense? What would someone do with policies like this? Would redeeming it make sense? Should he be investing his money somewhere else?
I really don't know, because this it is entirely a function of getting a pension of 3,000 rupee on advertising it, on advertising your old investment. I don't know the scale of investment, how and the term of the investment. So I really can't comment on is it a good idea or a bad idea. But I generally, my framework is that this is not the way to approach your pension. The way to approach your pension is accumulate your savings, and when you need to derive income from your investment, when you get into retirement, do it conservatively and be very aggressive when you have all the time, and gradually get conservative with your allocation. And most of the ULIPs or most of the endowment plans, or they're quite opaque with their cost structure. They combine a couple of things, so objectivity is lost when evaluating them. I would say that it is time for him to review all these investments. It is time to guard his future losses in relatively more expensive schemes.
But then from the looks of it, Colonel Singh tells us he's 50 years old, and these policies continue payouts until at least March 2025, which means that he is looking forward to another 10 or 15 years of working before he retires, which means he has some time left. What portfolio would you recommend he start investing in from the ones that we have designed, possibly to maybe accumulate some money before he retires?
No, I would urge him to, at least get into our stable growth portfolio. It's an easy thing to manage, and 15 years continuous investment, maybe rising investment, because we have made a very standard assumption that you invest 10,000 rupees a month. But typically, what happens is, as you approach retirement, your income keeps rising much faster, and it should not necessarily be a constant investment. I would assume that a 10% increase in an investment amount.
All right, Colonel Singh, that is the recommendation coming out to you, our stable growth portfolio flashing on your screen. Someone from our team will also send you an email of the list of those funds. Remember, you'll need to take a look at the policies, the insurance policies that you sent us. Take a look at how much money they will give you if you withdraw, and if it makes sense really then for you to continue those payments. But in the meantime, start investing in the mutual fund portfolio to strengthen your accumulation as you go towards retirement. If you have another 10 years to go, that's enough time to accumulate a reasonable amount of money for your pension. We're going to slip into a quick break. On the other side, one more group of people we haven't spoken to yet, those of you who've already retired. That portfolio is on the other side of this break. Don't go anywhere.